Hi, good evening, everyone. This is going to be the first lecture of macroeconomics. And, we're going to go ahead and introduce some of the very basic terms today related to GDP. As we progress, we will go ahead and we will look into the goods market equilibrium. We will look into the money market equilibrium. And from there, we will take the journey forward to the IS and LM curve. Further, after the IS and LM curve, we would be going ahead and we would be progressing with the AD-AS derivation. For the AD curve, I would be using the IS and the LM curves. And for the AS curve, I would be going ahead and I would be using the labor market. So I will shift my, discussion towards the labor market. Towards the later half of macroeconomics, I would be introducing some more aspects. Like first is the international economics. Then I would be introducing to you what is development economics. I'll be doing some essential models like Solow model, Harry-Domer model, etc. And finally, we would be wrapping macroeconomics by doing some of the important theories. Like for example, what is permanent income hypothesis? What is life cycle hypothesis? What is just-in-time investment? Some of the important hypotheses. That is how, I plan to cover entire macroeconomics. It's going to be, ideally my entire macroeconomics advanced course takes approximately 45 to 50 hours. But let's see how we progress and what all aspects, I intend to introduce. So to begin with, today's lecture is going to be about the gross domestic product. Now, because you are just beginning macroeconomics, it will be a good idea to keep a separate register and to start afresh from this course. Take entire time to go ahead because the classes are going to be on the weekend. Spend your weekdays on understanding the corresponding topics from basic and intermediate videos and make sure that you don't miss a single lecture. And if you miss, you look at the recording on the very same day so that you are at par in this subject. Okay, now let's just go ahead and look at the gross domestic product. So particularly speaking, the aim is to go ahead and to understand nation's total income or total expenditure on its output. And when I say output, I mean goods and services. There can be two ways, majorly three ways, but I want to focus on two ways to calculate the GDP of an economy. Either I can go ahead and I can say that this is going to be the total income of everyone in the economy. So I can say that whoever is earning income, if I add the total income of all those individuals, that will give me the GDP. Or I can say that it is the total expenditure of everyone in the economy. Let me begin by giving you an example. Consider what happens when you buy a car. When you go ahead and you buy a car from a showroom, you can either consider that because you are doing an expenditure, it would be added to the gross domestic product of the economy. Alternatively, you can consider that when you buy a car, it increases the income of the person from whose showroom you bought the car. And in that sense, it increases the GDP of your country. So either I can look at from the side of expenditure, or I can look at the side from the income. Both of them would account to the GDP of the economy. There is yet another method of which I will talk only during imputed GDP and later on, which is the value-added method. So this just says that you go ahead and you take the value of the final goods and services in the economy. Or the value that is added at each level. And when you do that, it is going to give you the GDP of the economy. So in that sense, because the car is produced in the economy, its final value must be part of the GDP of the economy. So in simplest terms, I can say that every transaction that takes place, and please write this down, every transaction that takes place, it involves a buyer and a seller. So the buyer is the one who is doing expenditure. And the seller is the one who is earning the income. And the transaction itself is in a way the output. We'll do this in later on when we do the equation of the transaction demand for money and velocity of money. I will tell you that the transaction is equal to the output in the economy. So in a way, when I transact, which means when I sell or buy output, one is incurring an expenditure, the other is earning an income, and the two must be equal to each other, and that must be equal to the value of the output. So in that sense, the three approaches become equivalent. Now, if we have to talk about economy, there can be various circular flows of economy. You would have seen the circular flow as 2 level, 3 level, 4 level. Let us take an example of a circular flow. So let's say that I have this as the household and I have the firms. The household is involved in giving labor to the firms. In return, when the household provides its labor to the firm would go ahead and provide its produced final good to the household. For these goods, the households will go ahead and give money to the firms. So there will be some expenditure. And against this, the firms would go ahead and the firms would earn some income. It will give some income to the household. This is the most simplest circular form possible. Now, if I divide this circular form, I can consider that there are two main loops in the circular form. One is called an inner loop and the other is called an outer loop. The inner loop has got to do with the real products. It's the flow of goods and services. And goods and services are real. They're in terms of units. 1 unit of labor, 2 unit of labor, 1 unit of good, 2 unit of good. So these are goods and services. On the other hand, when we look at the external flow, that's expenditure and income, they are my nominal variables. Nominal variables are in form of money. So income and expenditure are in form of money. So these are my in terms of money. And what this loop suggests that at the end of the day, how much real is generated and how much nominal is generated, they have to be synonymous to each other. You are going to spend money only against goods. You are going to incur income only against the labor that someone provides. Only then you're going to pay them wage. So they are synonymous to each other. And when it comes to GDP of an economy, I can completely do it in terms of income of the inputs, or because this has to be equal to this, I can very well do it in terms of the expenditure incurred by households. So the two are synonymous to each other, even within the basic circular flow of income. Now, whenever we talk about this GDP, based on what we have done till now, we can give a formal definition of GDP. And we want to focus on this definition a bit. So we can say that GDP is the value of final goods and services produced. So first of all, keep highlighting. I am saying it is final goods and services. We will focus a bit on this. And then it is produced within a frontier. Let's write domestic frontier. Within a given period of time. So the important keywords here are the following. First, it must be final goods and services. which means I am not going to go ahead and I am not going to include the goods and services which are intermediate. So if, for example, I am using cotton to produce cloth, then cloth would be included in GDP, but cotton would not be included in GDP. So this is the first keyword, that it only includes the final goods and services. The second keyword is within the boundaries of the country, within the domestic frontier, which means I am only interested in what is produced within my country, within my domestic boundaries. If it is produced outside my frontiers, then that is not a part of GDP. And the third thing is in the given period of time. So usually this given period of time is 1 year, or given period of time. So you would have seen that all the national accounting, it takes place for a particular period of time. For example, you'll prepare your balance sheet from April to March. You will give your government budget accordingly. So all things take place in a given period of time. Similarly, GDP should also be calculated for a given period, mostly 1 year, which means that, for example, let's say that there is a good which is produced in 2021. And now I am in 2022 and I'm asking, should I add the value of this good here if it was unused? The answer is no. That good or service should have been added in the year it was produced and not the year it is consumed. We are interested in understanding when is the commodity produced, and in whichever year it is produced, that is the year when it would be added to the GDP of the economy. So I am only interested in understanding for that particular given period of time. Usually, in most of the exams, they will be testing you based on the rules of GDP. So that should be absolutely clear as to what is included in GDP and what is not included in GDP. To do that, let us go ahead and write a few of the rules. So the first rule, adding different products together. Now just try and understand. I said that GDP is getting all the products together. It's the value of different products. I cannot go ahead and add cars to apples. How do I find out the GDP of the economy in which diverse kind of products are being produced? So the answer is that you should be taking the value of those goods at their market price. So please write down the first rule: to compute the values of different goods and services, the national income accounts, I will write NIA forever. So the national income accounts use market prices, right? So remember that when I talk about market prices, that reflects the willingness to pay by consumers. The market price, it tells us what is the willingness to pay by the consumer, which means that when I give it at the market price, I am exactly sure that that's the demand of the consumer because they're willing to pay that much for that product. So what do? Let's take an example. Let's say I take chocolates here. And let's say I take oranges here. Just an example. And let's say that this is the quantity and this is the price. So this is 4. This is $0.5. This is 3. This is $1. So what will be the GDP? The GDP, this price is the latest price. So the GDP is also for the latest year. So it will be summation PI, QI for different products, right? So 4 into 0.5 plus 3 into 1, which will be 5. There's just one more thing here. Note that sometimes whenever you calculate this GDP, they may in the question ask you, calculate GDP at 2021 for the current quantity, or holding prices constant, calculate GDP of this year. So you may want to identify only changes in quantity holding prices constant. I may want to understand that in 2023, both quantity and price will change. But if I want to understand that holding the affordability the same, what happens to the real output? How does only the quantity change? Then I may want to go ahead and find GDP for 2023 holding prices at 2022. This concept is called indexing. I'll do this shortly with you. But the aim of index is to understand that I don't want a change in the price. So note that when I talk about nominal GDP, price into quantity. So supposedly in year 2023, I produce the same chocolates. I only produce 4 units of chocolate. Then also, I notice that there is increase in my GDP. This means that the price would have increased. Sorry. This means that there would have been an inflation in my economy because I am producing the same output and yet my GDP of the next year is increasing. This clearly indicates an increase in price and not an increase in the output. But we are not interested in that. We are in fact interested in understanding that how does the output change from one year to another. So in fact, what we are interested in understanding is not the nominal GDP, but the real GDP. And what is real GDP? Real GDP is the value of goods and services in terms of units, or you can write goods and service in terms of units. So how much do I produce? That is real GDP. This is what we are interested in understanding. If there is increase in real GDP, which means if there is increase in the quantity that I produce, then that's an increase in welfare. But if there is increase in nominal GDP, then it may or may not be increase in welfare. Because nominal GDP can increase even when prices increase. And this is inflation. This is not creating any jobs. When real GDP increases, it means that my output is increasing, production is increasing, employment is increasing, so welfare is increasing. But if nominal GDP increases, yes, it increases the welfare if in the background it is due to increase in output, but it may not increase the welfare if it is due to increase in the price. So this is the first thing. Yes.
Ma'am, when the real GDP rises, ma'am, is it necessary that it is showing an increase in the welfare in the economy? And because, ma'am, in the time of recessions, there is overproduction. In that time, maybe also, ma'am, there can be a rise in real GDP.
Okay, fine. So, when you talk about overproduction, especially during recession, we'll talk about that later. But recessions usually arise because you have a lot of output which is unsold in the economy. Here I'm taking the case when my output is increasing, causing an increase in production and causing an increase in the employment opportunities. In case of recession, it's the opposite way around. It's not that my output is increasing currently. It's that from my output that was there last year, I have a lot of unsold inventories. Nobody purchased my product. So this year, the demand is lower. The next year, the demand is further lower because I just want to go ahead and make use of the unsold inventory. So in recession, it's not that from year to year, my output will increase. It would be the case that from the output that I already have, the economy would not be able to sell that output. Nobody has the income to purchase that output. So eventually the prices will start decreasing and people would not still be buying. They don't have jobs. They don't have income. That is the case with recession. So in that case, instead of just focusing on this, I would be actually focusing on what is my inventory investment. That is what my focus would be. So if you notice, you can get a graph for recession, the output is declining. Firms are not producing more, but they have adaptive expectations. They adapt every year to what happened the last year. And if nobody was demanding their product, they produce less this year. Again, they notice what happens this year. If no one purchases it, they produce less next year. So that is what happens during recession. Is that making sense?
Yes, ma'am.
Now, this is the first thing. This is the first rule. How do you add different products together? The second rule is got to do with the used goods. This comes again in a lot of exams. So if the product has been used, for example, if I have a car which I purchased in 2016 and I am planning to sell this car in 2022, this car will not be part of 2002's GDP. Of course, you know, if I am using an agent to sell this car, and I am paying some money to the agent, some commission to the agent, he provided his services this year. This is part of GDP. But this car in itself, this is not part of GDP. It would have been added in GDP the year it was produced. So please write down, sale of used goods is not a part of current year's GDP. GDP only takes value of goods and services produced in current year. So you will get a question like this, for example. It came last year in the IIT exam. So for example, it tells you the following, that you gave your service of maybe singing a song last year to Mr. X, but he didn't pay you any money. This year, he realizes that he had forgot to pay, some case study like this, and he releases rupees 5,000 in your account. They will actually go ahead and put 3-4 things other than this also, and then they will say you grew your own fruits worth rupees 6,000 this year, and some more example. They will make a complete story out of it. So the other part would come from what I do next. So they'll add 2 more, 3 more lines, and at the end they will say calculate GDP of this year. This is what the question is. So what you have to do is you have to take one part at a time. And here, if you notice, we just consider this. So this first part is that this amount was accrued to the last year. This is not what should be your earning in this year. So this must not be included in this year's GDP. So this is the first part that we are saying, that at least this 5,000 is not a part of GDP. Last year, they gave a question based on the illegal markets. And then they said that, you know, for that illegal market, somebody is providing services. Would that be included in GDP or not? So basically, they will give 4.5 points based on different rules, and finally ask you to calculate the GDP. Now, let's take the third rule. very important. This is treatment of inventories.
Excuse me, ma'am.
Yes.
In the previous point, if I resell the car like in 2022, what about the income I get out of it? Like it won't be accounted anywhere in the GDP?
No, that won't be accounted. Because that is what you are getting as part of the value of the car. So you would not be accounting it in 2020. It has already been accounted when you purchased the car for a higher value in 2016. So you would not account for that in 2020. Only if any additional income is produced, like this, you will account for that in GDP. Not anything related to the car. No. Because ultimately you're realizing the value of the car only. Same, they give example of households. So you purchased a house and then you sold that house 20 years later, your ancestral property, not accounted in GDP. It should be accounted only in the year it was produced. That's it, not later. Okay.
Okay, ma'am.
Now comes the treatment of the inventories. So inventory is what you produced but could not sell. Now this is very tricky. So it can be the case that the firm produced more than what it can sell. In this case, I will take various examples. So take the first case. Let's say that the product got spoiled. So consider this case. Let's say that the firm got a product produced, and yesterday only, we saw it in microeconomics that the labor market gets wages according to what they produce. So because a product was produced, the labor would have been paid for that product. So we say that wage has been paid. Now, this product that was produced, because it got spoiled, in a way, yes, we'll talk about illegality. It is one of the points. Any illegal item is not to be included in GDP, because I don't know that it was produced. The government would not know about that. So we will not include it. So let's say that this product got spoiled and the wage was paid, and correspondingly, let's say that the firm, because the firm cannot sell this product, the firm incurred a loss. That's a loss for the firm, right? So just think what is happening. If I go via the income method of GDP, so the income method suggests that GDP should be the total income earned by different parties. In this case, I have two parties involved. One is the firm and the second is the labor. When I talk about firms, what is happening? The profit of the firm is reducing. And when I talk about the labor, they are getting their wages, so they are getting paid that wage. And we know that from the labor markets that the wage should be paid according to the value of the marginal product. So ideally, we are suggesting that supposedly wages are paid about 100 rupees. That must be the value of the product, but that product is spoiled. So I lose out on that product, and therefore I lose out on this 100 rupees as a firm. So do you notice that one way I have an increase in money, and in the other way, I have a decrease in the money. And since they are equal to each other, therefore, there should be no change in the GDP of the economy. So if the product is spoiled, be careful. It is inventory investment only. You had this product with you, but now this product gets spoiled. So if the product is spoiled, it does not alter the GDP of the economy. And we have proved this through the expenditure method. Income method. That the income of one individual is increasing, the other party's income is decreasing. In the product case, because the two are equal to each other, the net means that there is no change in income. And no change in income means no change in GDP of the economy. Now, supposedly, I go ahead and I take the other case. Let's say that now product is not spoiled and it is put in inventory. So you produce this product. You could not sell this product this year. Now what do I do with that product? How do I deal with it? And it's not spoiled. So in this case, the first thing that is sure is that the owner is going to go ahead and pay the labor for its service. So the owner or the firm pays labor for its service. So if I look into it, wage is for sure increasing. This is for sure. Nothing is happening to the profit of the firm currently. The product is still with the firm. It could not sell it currently, but it may be able to sell that in the future. So because currently the product is intact, there is nothing wrong with it, I cannot say that I incurred any loss on it. So I can say that there is no change in the profit of the firm. So if I look at the income method, I can say that this is the income of various parties, so which will be profit plus wages. The profit is intact and the wage increased, so the income must increase. So there will be increase in GDP of the current year. The GDP of the current year will in fact increase. Now here is the thing. If I want to go ahead and I want to explain this using the expenditure method, then what do? Usually, whenever the firm has unplanned investment, which means that it is not able to sell its product, we assume that for that particular year, the firm purchased the product from itself. So we consider, please write this down, this is important. We consider that the firm incurred an expenditure to purchase the product from itself. We can also go ahead and consider this, that currently the firm went ahead and it is increasing its own expenditure because it is purchasing the product from itself to close the accounts. So in that sense also, we can think that the expenditure of the firm is increasing, and therefore from the expenditure method, we know that there must be increase in the GDP of the economy. So you can look at either way, but whenever there is an inventory which is not sold, but it is not spoiled also, there will be increase in the GDP. If there is inventory which got spoiled, it's of no use then. In that case, there is no change in the GDP. And let's take a third case. So let's say that now this firm, it is able to sell out of its inventory. So case 3. Firm sells a product out of its inventory. Now, there are two ways to consider this. If I am selling a product out of my inventory, it means this product does not belong to this year. Inventory, matlab, it was there last year. I just carry forwarded it. It's like it was there in my closing stock last year. So this year I brought it into my opening stock. It always existed. So if I'm selling this product which is out of my inventory, there is no reason it should be added in this year's GDP because it is not produced this year. So we can say that since it is not produced this year, must not be added to GDP. But I can go ahead and I can also give a second explanation of this thing. So we just said that when the firm had inventory, the year it did not sell its product, it is because it's like it purchased its product from itself. So if the firm purchased its product from itself, when it sells that product in the next year, isn't it like selling a used product? I could not sell it last year, so I showed as if I purchased from myself. I showed an expenditure on it. Using expenditure method, it became a part of GDP. And now when I sell it, it's like I am selling a used product. So even using that approach, I can say that it is like selling a used product. So even though it may have some positive spending by the public, by people, by consumer, the counter is the negative spending by the firm. So if the firm sells out of inventory, you do not add it to this year's GDP. Let's write down the general rule for this now.
Ma'am, will the spending by the consumer always be, the magnitude will the same be as the spending by the firm? Like, won't there be any difference?
It will be at the market price. But remember that GDP is always calculated at market price. I'll tell about that also. So, since there may be a chance that, last year the price was 10 rupees, this year the price is 11 rupees. So I might have made more money, but I cannot account inflation into account, right? So when I calculated the GDP, the entire price index was according to P equal to 10. So I may make more money here, but I will not say that that means an increase in GDP. So therefore, even if you release more amount from the consumer the next year, you don't add even the gap to GDP. No, nothing happens to GDP. You've already added at that year's market price to the GDP value. So you don't change anything in GDP for that transaction. Always GDP is the value of the goods. The goods must be added in the same year as they are produced at the market price in that year. So even if I change the market price the other year, does not impact the GDP of the economy. That's the way we calculate. Is that fine?
Yes, ma'am.
Okay. Now let's go ahead and write down the general rule then. So if there is investment in inventory, suppose they say inventory investment, it just means that firm could not sell the product, so it kept it to itself. It will be added in that year's GDP. But if there is a sale out of inventory, then inventory was already added earlier, so there will be no change in GDP. This is the general rule that we have. Now, the next term, so this was the third one, right? Yes. The third was treatment of inventories. The fourth one that we have, this is called intermediate goods. So here comes the value added method. The value added method suggests that either you add the value at each step. So when you produce thread into a cotton, cotton into cloth, cloth is being sewed, you add the value that is generated at each level. And value added at each level can be considered as value of output minus value of input. So for example, if I make cotton worth 100 and I used thread worth 80, then I just added 20 rupees. So either I add value at each level, or I simply give the value of the final good. I must not do both. I cannot say, okay, add the price of cotton, then thread, then whatever, cloth, etc., etc. I can't do that. If you add the value of all intermediate goods, then it leads to the problem of double accounting. So this is what the definition of GDP is. Only the value of the final goods and service or the value added at each level when the product gets transformed to a new product. Now let's go ahead and make the fifth rule. And this is the rule about imputations. So the first imputation that we want to talk about, this is going to be about housing. Let's take an example of rental housing. So if I am living in a rented house, then it means that I have to pay rent on monthly basis to the owner of the house. It is an expenditure from my side. It is an income for the other person. And hence it is part of GDP of the economy. There is a buyer, there is a seller, there is GDP involved. So people who are living in rented houses, they are definitely paying rent, which is part of GDP of the economy. But if we consider own house, then I am not going ahead and paying any rent. But if I wouldn't have lived in this house, I would have definitely paid money to someone. So for example, there can be two cases. If it is my own house and I am not living in it, I am giving it for rent. Somebody would have paid me a rent worth maybe 20,000. But when I live in this house, I forego this rent. This money that I forego, this is the opportunity cost of me living in my own house. So the money that I could have earned becomes my imputed rent. And I must go ahead and include this imputed rent as part of GDP of the economy. So in case of housing, whenever a rent is involved, imputed rents are in fact part of GDP of your economy. The second example is government services and goods also, in fact. So first of all, let's consider government services. Government services are not sold in the market. When the government is doing something for you, it is not selling that in the market, and therefore there is no price involved for that good or service, especially service. So let's take an example. For example, the government is concerned about the welfare of the individuals, and it is providing its service to ensure that there is increased welfare. I cannot give a market value for it. So market value not defined. And therefore, I don't know what value should be added to GDP. In this case, we can add the wages, income of government officials. So for example, the person who is working in railways, he is the government employee. I will add his income. I will add the income of the individual who is getting money for building the flyover for the country. So I will add the wages and income of the government official because I don't have any market price. So other than this, whatever goods they produce, they can be added at the market price. For example, if they produce a train, then the value of the train at the market price, every token that is sold of the metro, that value, all that goes to GDP of the economy. So only what can be marketed, I will go ahead and put its value at the market price. And because of this, we can come to the third case, which is households. So the services of a housemaker, the services provided by the affection provided by grandparents for their children, all that is not included in GDP because I cannot find the market price for those products. So the housemaker, grandparents, housewife, etc., I don't include their value in GDP because I cannot impute the value for them. Similarly, although I can impute the market value of the goods I produce at home, I don't include their price in the GDP of the economy. To give you an example, suppose I prepare a pasta at home. Now, someone may argue that if you didn't prepare this, you could have gone to a cafe, you would have purchased it for 600. So therefore, the pasta that you prepared for home should be included as 600. I don't include the imputed price of the goods consumed and produced at home. So that is also not included in the GDP. And finally, we have underground market, as you were mentioning. So underground economy is also not included in the GDP of the economy because that is not accounted. I don't account that in the national trade, in the national accounts. So someone, you were asking Smriti, what when government knows about this illegal goods? So even if the government would know that there is an illegal market which exists, unless you don't account for it, if it is a black market, for example, let's say that, supposedly I start collecting money in cash for all my transactions that I do, and I don't show anything in my bank account, then that is a black market. That's an underground or illegal activity. That cannot be included in the GDP because no transaction is made in my bank account because there is nothing linked to my PAN card that shows that a transaction was made. Now, the government can do something which is known as, this is done especially when people do tax evasion. This comes as a very important topic in public economics. Tax evasion is when people evade tax, and the government knows that many people are not paying the tax. And how does the government know that? Because the expenditure is very high as compared to income. So for example, let's say that although I didn't show my income to the government, I am doing heavy expenses. Every year, there is 5 kg milk that comes at my place. Every year, every day, 5 kg milk comes at my place. A lot of, exclusive food comes at my place. So expenditure I am doing. Government knows that there is this illegal market that trade takes place. But as long as I'm evading that, I'm not showing it to the government, it is not a part of the GDP. Here the government can act. It can reach out to people. It can do some, it can bring in some punishable things to let people know not to evade tax, to tell their true income. If the government is successful, people will have to reveal the true income, then it will be included in GDP. But just the government knowing will not include in GDP. People revealing the income will include that amount in GDP. Otherwise, it will be part of the underground activity and it will not be included in GDP. So, underground economy, household work will not be included in GDP. Rentals are included as part of GDP, even if I am living in my own house. That's a part of the GDP of the economy. So, these are some of the rules that I wanted to discuss. We'll take just one last thing for the day. Type of GDP. I've already discussed this, but just note this down. There are two. One is nominal, one is real. Real is at a constant price. So it's like PX, QX, PY, QY, but price is at the base year. I don't change the year. Nominal is at the current price. So it's like PX, QX plus PY, QY at the current year. Here, this can increase either due to price or quantity. This only increases due to quantity. So I can define based on these two what we call GDP deflator. And that can be defined as nominal GDP divided by real GDP. So this GDP deflator tells me about how much is the change that is due to inflation in the economy. So in a way, you can say that GDP deflator, it is used to deflate. Deflate means bring down. It's used to deflate nominal GDP to real GDP. So it is going to tell you, it's going to deflate the price of the output relative to its price in the base year. And you can just kind of write it as summation PI QI in the current year upon summation PI QI in the base year. And just imagine that if GDP deflator is 1, then I am saying summation PI QI in the current year is same as summation PI QI in the base year. So this implies that there is no inflation that would have come up. No inflation came place. The GDP is the same in the 2 years. Whether I found it using current year prices or the base year prices, it fetched me the same value. So there is no inflation that came. Okay, we'll stop here for today then. Tomorrow, I will begin with the different types of GDP and we'll discuss in detail what is the expenditure method so that we can use it in the derivation of the IS curve and in the derivation of the AD curve. Yes.
Ma'am, I want to ask one question in the last 0.6 number that underground economy. If government knows that economic invasion has taken place and if government raids that place and collects that money, then that money can be added in GDP.
GDP, yes. That can be added in GDP because that is now a revealed income of the person. If it is revealed, if it is in my national accounts, I can put it in GDP. Yes.
Okay, ma'am. Thank you.
Okay, thank you.